Most of Vermont's political leadership this week remained focused on flood relief, helping thousands of impacted homeowners and business owners find help to clean up. Recovery, we know, will take a long time. The capital city of Montpelier remains a shadow of its former self. Most businesses still closed, state buildings fenced off, many still attached to giant ventilation tubes to try to keep mold growth at bay. On Thursday, applications opened online for small business owners to apply for a piece of the first $20 million in state recovery grants. We know it won't be nearly enough.
I think there are going to have to be some buyouts of mobile home park owners.
That was the governor at his briefing this week. The breadth of the damage becoming clear. FEMA disaster recovery centers are now open in Barton and Plainfield, Waterbury, Rutland, Barry, Londonderry, and as of Friday, Springfield as well, helping Vermonters kickstart their recovery, as FEMA puts it. Line up help, upload documents, and get your questions answered in person. Meantime, the flood and the impact it will have on the state economy moving forward now very much on the minds of business and political leaders who are listening closely at the semi-annual economic forecast released this week at the State House. Two veteran economists give us a sense of where we are now and maybe heading. Joining us this morning, Tom Cavett, the veteran state economist for the legislature. Your compatriot, Jeff Carr, with whom you draft the consensus report, was unable to break free for our conversation, but we're thrilled you're here. Thanks for being with us on NBC5 In Depth.
Happy to be here, Stuart.
Tom, you time your semi-annual forecast, economic forecast, with the end of the fiscal year. You now have those numbers that were out this week. It looks like Vermont ended with a surplus.
It was 1% higher than what we had forecast. So nice that it was a little bit higher, but on a budget of $3.2 billion to be 39 million over is pretty much spot on. So I don't think it's sort of giant surplus, but more of a rounding error, but it's nice that it's on the plus side.
Beats the alternative, right? Well, personal income tax receipts, which we are in the media trained to look at first because they're the most important revenue source for the state, they have missed for, 5 months in a row now, but we haven't felt it because those revenues have been offset by surging corporate income tax revenues. And I'm wondering what is going on?
Well, both those categories of revenue are very volatile. So particularly on a month-to-month basis, there can be a lot of noise. There are categories of revenue like sales and use that are very, very stable. So if you see something happen over 3 months, that's probably a start of a trend. But in personal income, it's very erratic. So we had forecast declines, but it was more of a decline than we had projected. It was offset both by corporate, but as important is a new source of revenue that we rarely see at these levels, which is interest income from the cash balances that the treasurer manages. So those two things more than offset the decline in personal income. But there's tremendous volatility in both corporate and personal income. But corporate did very well, in part because in an inflationary environment, corporations have been able to pass on, for the most part, their costs and sometimes a little bit more. That increases probability. Margins have widened, and therefore their tax liabilities are a little bit higher. But demand has continued to be strong. Consumers keep spending, and so there's still a lot of demand for product, and so their profitability has been solid. We expect that will decline.
Let me ask you to look forward. Your report to the Money Committee chairs and the governor this week was fairly upbeat. The state saw a revenue upgrade in all three of the major funds, not enormous, but significant for the coming year. But it does not include the impact of the July flooding. And you were clear about that. You don't have the data yet, but what do you think the impact might be?
Without looking at the data, it's impossible to say. And we've done these kind of analyses in other parts of the country, in Colorado for the Department of Interior with respect to wildfires, and in Texas, Louisiana, and Mississippi for flooding events that were related to hurricanes, Hurricane Katrina in particular. And you really need to look at it at a very granular level. You have to know what sectors of the economy were impacted, how widespread the damage is, and then importantly, how much money comes in to offset that. In 1927, when Vermont had this horrific flood, there was very little in the way of federal money that came to the state for remediation. Self-funding that took quite a while. And if you're self-funding it, you're also having to tax yourself to generate that, and that is a drag on the economy. But in today's world, there's federal money and a lot more private insurance than existed back then too. So you'd have to look at both sides of the ledger and then add it up. I mean, it will be undoubtedly a big loss for many businesses and many people. But the net economic impacts, it's too early to say what those might be.
Okay. What do you see going forward in terms of a couple of big macro questions? A lot of pressure on Vermont employers to raise wages because of our tight labor market. As we look forward for the next year or two, do you see any easing there? And I want to ask you about the housing market.
Well, I think that there has been and will continue to be wage pressure when labor markets are as tight as they are. So you've got these opposing forces going on. In that report that you referenced, there are three charts right at the start. The first one is sort of the problem, which is inflation. So it's not just wages, but lots of things have conspired to cause a spike in prices a year ago that hit 9%. Those have come down substantially since then. The latest readings are extremely encouraging. It's all the way down to 3%. But I don't think anybody expects sort of just a smooth transition all the way down to where the Fed wants it to be at 2. I think it could bounce around, it could go up. And labor costs are a big part of that because those tend to be lagging other price increases. A lot of people's reviews are done annually or sometimes less frequently than that. Contracts are often multi-year. So when they get renegotiated, if there's any bargaining power, and you're seeing this with a lot of organized labor contracts that are occurring all over the country, they're wanting not just to make up for the last year, but since their contract was set, and that can sometimes be 2 or 3 years. Well, if you add up all the price changes over that period, it can be 20% or even more. So I think there are still a lot of price pressure that will occur. But if not, then the thing that is, likely to slow the economy in fiscal 24, which is the interest rate increases, they might be able to take their foot off the brake, and we could have sort of what's been described as a Goldilocks situation where unemployment doesn't rise that much, inflation drops, everybody's happy. I mean, without the inflation, this would be an extraordinary economy. Yeah. I mean, this just firing on all cylinders, and jobs for anybody who wants them, wages going up, wealth, household wealth has increased dramatically. And even at the lowest level, and I know this, and there are stats in this report about this, but it's kind of extraordinary that the lowest 50% of the population only has about 2.5% of the total net worth. But that's gone up from 1.9% before the pandemic to about 2.6%, 2.5% currently.
All
So
right,
that's
what about the price? What about the price of my house? The median home price in Vermont. Again, we face an unbelievable housing shortage. Do you see prices still rising?
Yeah, well, the latest data on that and the best data come from the FHFA, and they have a very extensive, they're refinancing mortgages. So they're touching most of the properties that transact, and their price measure is the most reliable. The latest data, the first quarter of 2023, and that showed continued increases on a year-over-year basis, but a pretty dramatic slowing quarter to quarter. So there's no question that's going to come down. But what you have happening in markets is, first of all, the real estate cycle, typically you get a run up in prices based on demand, and there's time for a response for builders to build more because they see they can make a lot of money with this. Right about as that was getting started, that mechanism getting started, the Fed raised interest rates by 5 basis points. Well, most properties are transacted with borrowed money. So that slowed activity. You didn't get a lot more stock added. So we don't have a situation now where we're oversupplied, and that's why they'd be declining. It's a very unusual market. And you have people that have an incentive not to put their homes on the market because they maybe have a 2%, 3% mortgage. And if they buy something else, they're looking at 6 or 7 or even 8. So the market's in a really unusual place that's keeping prices pretty high, but they're going to be coming down.
Last question. What do you see as the greatest risks to the state economy, over the next year or two?
I think clearly the biggest risk is the Fed might overshoot the amount of braking that's needed. The effects of higher interest rates occur with lags, and so it's quite imprecise. And if inflation were to kick back up, they'd push harder. And every example in history where they're pushing hard leads to pretty dramatic slowing. So we'll see if this one's different. Some people think it might be because of all the federal stimulus and a lot of private money that's still out there. But that is the biggest risk, is they overshoot and we get not just a slowdown in fiscal 24, 25, but something that would be more severe.
Tom Cavett, the longtime economist for the legislature. Great to have you back on.
Thank you, Stuart.
Coming up, the NAACP